Hello everyone, this is ACCA Amit Kumar and I am here to discuss with you in the series of property, plant and equipment. A day before yesterday I discussed with you classification of assets, and today I plan to discuss with the standard on tangible assets, that is IND AS 16 property, plant and equipment. So if I share a brief about me, I got a chance to train on IFRS in 2009, and since then I've been training on the subject of IFRS and IND AS and have worked with various corporates in the last 10 years. I've been part of Pyron Corporation, was with Axis Consulting, was leading IFRS trainings at KPMG on behalf of Accounting Advisory Services, was with TMF Group for a brief time, and till recently, I was a director with Accounting Advisory Services BDO India and was head Learning Solutions Pan India for IFRS and IND AS trainings. Currently, I am founder and CEO of Promesha Business School. I am offering ACC qualification here at Dehradun. So my experience in the last 10 years has been into mainly IFRS trainings and IND AS trainings. So in that series of introducing the educators on Unacademy CA final, so we all educators are coming together to teach CA final subjects. So I'll be discussing with you IND AS 16 property, plant and equipment. So as the name goes by, property, plant and equipment, the standard applicable is IND AS 16. They are covering tangible assets. So tangible asset means that we'll be covering the standards which are related to the assets which are being consumed into the business. So I'll be mainly covering non-current assets. The assets which are being consumed into the business means that which you intend to use as part of the business. You plan to use them as part of your primary source of generating or producing goods or providing services. So when you consume an asset into the business for more than 1 year, it is considered a non-current asset, and if it can be touched, if it can be felt in its physical presence, you can see the wear and tear happening, it is a non-current tangible asset covered under the head IND AS 16 PP. So anything other than current is considered non-current. This is very interesting definition, that anything other than current is considered non-current assets or non-current liabilities as part of IND AS or IFRS is concerned. So something we are planning to sell within 1 year or holding for trading purpose, or we expect it to be realized within 12 months from the reporting date. Remember, we prepare financial statements of a particular reporting date. In India it is 31st March. 12 months from this date, if we plan to realize something within this period, sell something within this period, is equivalent to cash or cash equivalent. Cash equivalent means that something which has a maturity period of 3 months or less, and it can be realized within the normal operating cycle. Now here's a cash with the normal operating cycle. Normal operating cycle for some of the inventories can be more than 12 months. So there's a relaxation here that even if the normal operating cycle is more than 12 months, it will still be considered as part of current assets, and inventories form part of current assets. Anything other than them will be considered non-current. So examples of current are like inventories, receivables, cash and cash equivalent, advance tax, short-term investments, trade investments. Anything other than them is considered non-current. So in the non-current assets, we have property, plant and equipment, which is a declaration to the world that we are going to consume these assets into the business. Other than them, there are long-term investments which are covered under IND AS 109 financial instruments, investment in subsidiaries covered under the consolidation standards, investment properties covered under IND AS 40. I discussed in the previous session that we have only one model, that is cost model. And goodwill, brands and patents covered under IND AS 38. Only purchased goodwill gets recognized, internally generated goodwill doesn't get recognized. So we'll be covering property, plant and equipment. So what are these? These are held for use in production of supply of goods or services. You are using a factory for producing goods, you are using a hotel for providing services, you are having a land and building for rental to others because that's your primary source of income or business, or you are having a head office and using one of the buildings owned by the business. So when you consume an asset into the business, that will be covered under the head property, plant and equipment. So it is being used for business operations, like either the employees are using it for managing their office affairs, or employees, if it is residential property which is owned by the business, it may be happen that employees are living in those properties or using for office purposes. There is a car which belongs to the business, but this car is being used by the CEO for business operations only. Then this car will not be considered a personal property of the CEO. This will be considered of the business being consumed into the business. It will be subject to depreciation. May be subject to depreciation means there is one item in non-current assets as part of IND AS 16, that is land. Land is not depreciated. Now, I normally ask this question, why land is not depreciated? What do you think? What is the reason behind land not being depreciated? Many of the answers I get is land is always appreciated. Land doesn't fall in value, but that's not true. In this COVID situation, land price has fallen substantially. In the countries where they are hit with the war or some other calamity, land prices do fall. So land prices doesn't always rise, they also fall. But the real reason for land not being depreciated is it doesn't have a defined useful life, and is the reason we use a term known as infinite life. We believe that life on earth will continue to exist for an unknown or unseen period. So we use the term infinite, not defined today. We don't expect it to be defined even tomorrow. We expect life here to be forever, unless there is an ultimatum from Mars that leave planet Earth by 2050. I think that day we may get to know that the time period on Earth is limited, if there is a defined life, but that day will not come. We hope so. Being optimistic, I don't believe that land's life will ever be in a definite period situation, except it is a mining land, which we can see the wear and tear. So they can be divided into, this property, plant, equipment can be divided into various components. If each component has a different useful life, we should divide them into various components, and each component should have a different useful life, depreciated differently. So mainly the depreciable component, non-depreciable component is term used for property. Property here I mean land and building. So land is non-depreciable component and building is a depreciable component. Now what does depreciation really mean? What we are trying to achieve through depreciation? What is the real objective? We have spent on a property and we spent 500,000. We charge the entire amount as part of our expenses. But someone objected that this is not fair, that charging the entire amount to P&L is not fair, that this is not your expense. So then it was decided what is the next area to look at, how long we plan to use it. We decide to use it for next 10 years, and after that we believe that this will be consumed into the business and this is the life. Okay. Next is, how do we plan to use it? Do we plan to use it evenly or more in initial year, less in later years? If it was a machine, we could have used that definition. For a property, we can use it evenly. I think it will not make much of a difference. But if it is a machine, then the question may be whether we are going to use it more in initial year or less in later years, and we may define a useful life of 5 years. And it's our company policy that we replace these machines after 5 years and buy new one against 5 years. On this machine, suppose we spend 100,000. Again charged to P&L. Again there is an objection. No, we are going to use it for 5 years. So all the years which are going to get benefited out of it should bear the cost of this machine. So we decide a systematic allocation which is known as depreciation. Agreed that we have decided a depreciation method. Once it is decided that this 100,000 will not be charged to 1 year, it will be charged to all the years which get benefited out of it. So we'll match the cost with the revenue being generated, because we are going to earn revenue for around 5 years on this property. Then I get to know that even if I sell it for scrap, in the worst of the worst scenario, I am still able to receive 20,000. If I sell it even for scrap after 5 years, I will be able to recover 20,000 even by selling for scrap. The business has spent 100,000 today. How much is the responsibility of the business to recover now that they are believing that 20,000 they'll get anyway? How much is the responsibility of the business? How much they should recover? The responsibility of the business is to recover how much amount? They spent 100,000 today. 20,000 they'll be getting in worst of the worst scenario. That means a depreciable amount is 80,000. In layman language, I normally say that this is the amount to be recovered through P&L. Why I say recovery through P&L? Suppose after 2 years, the net book value of this asset is, and we decided to charge straight line depreciation. This was bought for 100,000. 20,000 will get in worst of the worst scenario. 5 years the useful life. So 16,000 is the depreciation every year. If 16,000 is the depreciation every year, 32,000 is the depreciation for 2 years. In the worst of the worst scenario, we'll be able to recover 20,000. So 78,000 is the net book value. This is one way of presentation. The same asset, if I would have presented in a different manner, machine worth 100,000, useful life 5 years, residual value 20,000, depreciation every year is 16,000. This depreciable amount is 80,000. So there are two ways of presenting it. One, I would have directly written down the net book value at 100,000 minus 2 years depreciation, that is 32,000. Net book value would have been 68,000. The other manner of presentation would have been, I would have kept the machine at 100,000 and would have created a provision or allowance for depreciation. I'll use the term allowance for depreciation. This provision means we are liable to pay to someone, we are not liable to pay to anyone. So allowance for depreciation is 32,000. Both look the same, one and the same thing, but this gives us better way. What if I sell this machine? What if we sell this machine for 82,000? How much is the gain or loss? How much is the gain or loss? Gain or loss on disposal. If the net book value is 68,000, if I sell it for 82,000, how much is the profit? We received cash account, debit 82,000, credit machine 68,000. The difference is gain on disposal. Why I'm writing both the method? Because it has a relationship with the model. When we use revolution, what it has a relationship. The manner of presentation determines your accounting in future. Now in this case, what will happen? Cash account, debit same 82,000. But machine, when it gets credited, in this example, when machine gets credited, machine is getting credited at an amount of 100,000 here. There is a difference. And there is an accumulated depreciation which we say that also get de-recognized. My question is why? My question is why this accumulated depreciation gets de-recognized. What is the reason behind it? This is one way of looking at things. This is another way of looking at things. Both have valid ways of presentation, no doubt about it. You can directly charge the depreciation or you may not charge it. Both are equally valid. In this, I say that any depreciation which we have charged till date, which has been accumulated, also gets de-recognized on disposal of this property. My question is why? Why I am de-recognizing it? 32,000, and then I get to know the profit or loss on disposal, which it turns out to be 32 plus 82 minus 1,14,000. Same gain on disposal. Correct. So what I understand as a layman is that the asset which I bought for 100,000, the business has already recovered 32,000 by way of charging depreciation against the profits of the company or profits of the year. First year they charge 16,000, second year they charge 16,000. The business has been successful in recovering 32,000 through the affairs they did in last 2 years. They could recover 32. How much is yet to be recovered? How much is yet to be recovered? 68,000 is yet to be recovered. Now someone is ready to pay 82,000. If someone is ready to pay 82,000, we wanted to recover only 68,000 what we spent. So someone is ready to pay more, means that is gain on disposal of this asset. Whenever manner of presentation is this, I mean the same thing, that now someone is ready to pay 82,000. We have already recovered 32,000. The total recovery till date which has happened is 114,000. We have recovered till date 114,000. How much we spent? This is recovered. I'll use the term recovered here. How much we spent? This is what we spent. We spent 100,000. So if recovery is 114,000 and if you spent 100,000 till date, that means how much is the gain or loss on disposal? The gain or loss on disposal is 14,000. The reason why I am stressing on this point is this has a lot to do with the model we are going to use in IND AS 16 property plant and equipment revaluation model. So you have been studying it in the previous studies as well because it has changed now. The revaluation model, when we do revaluation model, here I sold something, I got cash. If the same question I ask you, what if I would have revalued the machine? What if we revalue the machine and revalue the machine at by 82,000? Or we take it, increase the machine. What if we revalue the machine to 82,000? That will make more. What we are doing in this case? The machine which was booked at 68,000, suddenly we wish to record it at 82,000. What will it mean? Machine account, debit. How much is the increase? 82 minus 68, because 68 is the net book value, 14,000. What about the credit? What is the difference between a sale and a revaluation? When we sold the machine, we could realize it in the form of cash. But the moment I declared that we are going to revalue the property to 82,000, what if we revalue the machine to 82,000? Still the gain is same. When we sold it for 82,000, we could realize a gain of 14,000. But when I revalue the property from 68,000 to 82,000, the difference is that this is unrealized gain. I'm not able to cash it. I'm not able to get this cash. It's simply a change in the books. The same asset which was carried in the books at 68,000 now will be carried in the books at 82,000. But it didn't make any impact on the bank statement or the cash flow. Simply the asset is inflated in the balance sheet. So this is different from a sale. In sale, we does get a gain, but it is a realized gain. It increases our cash flow and we take a decision, we realize it in the form of cash. But when I increase the value of a machine from 68 to 82, this is unrealized gain. These unrealized gains are not shown as part of P&L. They are shown as part of revaluation surplus. There is a revaluation surplus created as part of OCI. Revaluation surplus is shown as part of other comprehensive income. There is a new statement other than P&L. There is another statement known as other comprehensive income. In other comprehensive income, we'll show this gain, OCI. Because OCI is meant for this purpose only. It shows unrealized gains or losses. What will be the accounting treatment this side for the same machine if we revalue the machine to 82,000? If I use the same language, revalue the machine to 82,000, in this case the machine will be falling down to 82. So there will be fall in value in this scenario. If I reduce the machine to 82, let me try. Machine account credit accumulated depreciation relating to it will be debited, which is 32,000. Machine account will be credited by how much if I reduce it down to 18,000? What about the difference? Where will I record this difference? Credit, revaluation surplus. But if you notice that the manner of presentation has a lot of impact on the accounting for a revaluation model. In this it was straightforward. So you need to read very carefully what the revaluation means. Revalue to 82,000. In this case, when it is revalued to 82,000, in both the cases it is revalued to 82,000, means when we do revaluation exercise, the asset is considered to have got a fresh lease of life. It is a fresh new asset being introduced into the business. We will review its useful life, will charge depreciation on the revised, reviewed new life. It will get a new life. So any depreciation till date is de-recognized relating to it. Any depreciation relating to it is de-recognized. In the same manner, if you notice, there is no difference between a sale and a revaluation. The only difference is in a sale we were getting cash. In a revaluation we are not getting cash. So we need to be careful about, because the machine is still with us. There we were disposing of the entire machine, if you noticed. It's gone out of the books. Here the machine is still with us, but at a reduced price. We reduced the value of the machine from 100 to 82,000. In this case the value is reduced, but if you look at the net book value perspective, the value has increased from 68 to 82. So the language can be, the existing accounting can be this, and the language can be the machine value was increased by 14,000. If I use the same language for this, the machine value was increased by 14,000, the machine will increase from 100 to 114,000. For this, I'll have to use the language, the machine value was fallen by 18,000 or it fell to 82,000. So be careful. You always need to know what is the existing way of presentation. The existing way of presentation is by charging depreciation to the historical cost and presenting it in the form of net book value. The language will differ. But if you are creating a allowance for depreciation, your language will matter that what should be your subsequent or following accounting on the basis of the terms and conditions mentioned. So be careful, because if I use the same language here, machine value increased by 14,000, it will mean machine increases from 100 to 114. If I use the same language for this, machine value increased by 14,000, it will mean that it increased from 68 to 82. So this it is fine, is the reason I took a common way of looking at it. What if we revalue the machine to 82,000? So in both the cases it meant the same, that I need to, in this case I need to bring the machine value up to 82,000, in this case I need to reduce the value to 82,000, but the accounting remains the same because the cash flow position, the expected recovery is same. Here we have recovered 32,000 and the machine has fallen by 18,000. So still there is a credit, there is a gain of revaluation surplus. What is the accounting hereafter? As I said, your manner of presentation determines your accounting even in future. So there are two models in IND AS 16 PP. One is cost model and one is revaluation model. When you move from cost model to revaluation model, this is considered applying an accounting policy for the first time. Once you move on to revaluation model, you need to follow the principles of revaluation model. So as I said, initially the manner of presentation matters a lot. The manner of presentation matters a lot. So what will be the situation after this is revalued? The machine will be reinstated at 82,000. In both the scenarios, machine will be at revaluation surplus of 18,000. This will be the status. In both the cases, machine price will come at par 82,000 and revaluation surplus has a balance of 18,000. But once it is done, the accounting hereafter changes. We need to review the useful life. And we assume that the remaining useful life is 3 years. The remaining useful life is 3 years. So depending on the manner of presentation, in this case, net book value will be 82,000 divided by 3 will be the new depreciation. So net book value will simply directly deduct this depreciation charge and record it. In this case, the machine will continue to be recognized at 82,000 and there will be allowance for depreciation. Allowance for depreciation, which will be same amount. So as I said, your manner of presentation and what will be the impact on your revaluation surplus? How to deal with this? We will touch this or will not touch this? What do you think? Now the remaining useful life is 3 years. How much was the life earlier? 5 years. And after 2 years of depreciation, we did this revaluation exercise. Remaining life is 3 years. How much is excess depreciation because of this revaluation exercise? How much is the excess depreciation being charged? How much is the excess depreciation being charged to profit or loss account? Simply because we revalued the asset. How much was depreciation charged earlier? depreciation charge earlier was 16,000. How much is depreciation charge now? 27. How much is excess depreciation? We were having an asset worth 100,000. We were depreciating it over a period of 5 years. Residual value then was 20,000. So we were depreciating it at the rate of. We believe residual value remains the same. If residual value remains the same, the depreciation charge now should be 62,000 divided by 3, that is 20,667. So we have a choice for excess depreciation, that we can transfer excess depreciation from revaluation surplus to retained earnings at the end of each year. So whatever is excess, whenever we revalue, we need to reassess the residual value, depreciation method, all these we need to reassess. So in my depreciation charge earlier, I was considering the residual amount. I again considered the residual amount and got to know the depreciation charge should be 4667. So net book value turns out to be allowance for depreciation this is taking into account 82,000 minus 2667. So there is a choice that either you transfer excess depreciation from revaluation surplus to retained earnings at the end of each year. This will help in minimizing this accounting mismatch, which is happening because you simply revalued an asset and you are charging higher depreciation. Simply because of revaluation, you are charging higher depreciation to profit or loss account, which should not happen. Earlier, we were charging a depreciation of only 16,000, but simple act of revaluation is resulting in a higher depreciation charge to P&L. Now, revaluation surplus cannot be reclassified to profit and loss directly. So the only way is that we transfer excess depreciation from surplus to retained earnings at the end of each year. So the entry will be revaluation surplus, debit, and credit retained earnings. The other way is wait till disposal or de-recognition of the asset, and any revaluation surplus related to the asset will be directly transferred in lump sum to retained earnings from revaluation surplus. So we need to keep a track on this. To revaluation surplus related to an asset, we need to keep a track on any revaluation surplus related to any asset, because we need to either transfer the excess depreciation each year or we need to transfer one lump sum amount to retained earnings either on derecognition or disposal of that asset, whatever the situation. So why I purposely related to it? Because the manner of presentation matters a lot. A simple method of charging depreciation, the way of presentation determines your accounting in the revaluation model, is the reason I stressed a lot on this point. And what does depreciation means. Depreciation is a systematic way of recovering the value of an asset. Some of the value we are going to recover, even in the worst of the worst scenario, we'll be able to recover something in the form of scrap. But then there is an amount which we believe we'll be able to recover only by use of this asset. So the asset wears and tears, it is being consumed, it is being used into the business. So there is a cost of that use. That cost of that use is given a systematic allocation that is known as depreciation. Now depreciation, depending on the pattern of consumption, if we believe that we're going to use it evenly over all the years, we charge straight line method. If we believe we are going to use it more in initial years, less in later years, we'll use written down value method. Then production of units method, on the basis of production of units an asset can produce. An engine can run for 50,000 hours, or a machine can produce only 100,000 units, depending on the number of units it can produce and how many units we have produced in year 1, year 2, year 3. For how long we plan to use this asset becomes the basis for charging depreciation. In my previous session, I also discussed with you a scientific way of charging depreciation. So I'll not repeat it. You can refer to the YouTube video relating to the same classification of assets for understanding it in more detail. What was the another method? Because if I repeat it, it will not make any sense now, because it has been discussed. Sum of digits method was another method of depreciation which was discussed in my previous session. You can refer to it, which assigns a digit in descending order. It is a scientific method in case we are not able to know what is the pattern of consumption. Now pattern of consumption is an estimate on the basis of the expected pattern of consumption of use of asset. On that basis we charge it to profit and loss account, and the name given is depreciation. Hope this is clear. IND AS 16 property, plant and equipment has two models, cost model and revaluation model. I showed you a glimpse of the revaluation model, what happens when revaluation is done, how is it different from sale. And on sale we get a realized gain or loss. On revaluation it is not sold, but it increases in value or falls in value. That increase or fall results in an unrealized gain or loss. So it is recorded through the mechanism of revaluation model. Another impact which happens on IND AS 16 PP is that if you're using revaluation model, the revaluation model is capable of managing the impairment losses with sufficient regularity. Now when I use revaluation model, I'm not required to revalue the item of property, plant and equipment every year. We will be required to do so with sufficient regularity. The revaluation model may result in upward revaluation, may result in downward revaluation. We took an example of an upward revaluation just now. So the principle says that your revaluation, first time revaluation determines, first time revaluation results in accounting depending on whether it resulted in an increase, or decrease, which also means that resulted in increase means first time revaluation was upward, first time revaluation upwards. If first time revaluation is upwards, means we have a surplus, we create revaluation surplus. Like in our example, the property which was worth, the machine which was worth 68,000 increased to 82,000. So we have a revaluation surplus of 14,000. A revaluation surplus is created when there is an upward movement. Create revaluation surplus on first time revaluation. First time revaluation upward. If first time revaluation is a decrease, that means first time revaluation downwards. What does it mean? The same machine which was standing at 68,000, if we say it has fallen to 40,000. What will be the entry? Machine account, credit, debit, profit or loss account, 68,000 minus 40,000, 28,000 is the fall in value, and we charge it to P&L. Why first time revaluation is important? Because if it is upward, we create a reserve. If it is a decrease, first time revaluation is a decrease or fall in value. This results in a charge to P&L, charge to profit or loss. You can say expensed. Now, depending on what happened first will result in your accounting in future. What happened first time? If you have a surplus and subsequent revaluation there is a fall. I suppose this machine after 2 more years it had a net book value of say 82,000 charged to depreciation for another 3 years. I'm just taking without any residual value, and net book value of 82,000 minus 27. This is the net book value after 2 years, and it falls in value now to an amount of say 40,000. How much is the fall? Or say 39,000 to avoid any confusion with the other figures. The total fall is 15,667. So what will you do? You should charge it directly to P&L, the fall, since in first time revaluation downwards we charge the entire amount to P&L. So you may be thinking that in this scenario also, when we have a reserve of 14 and there is a fall of 15, shall we charge the entire amount to P&L? I sometimes say that when we have money in our pocket, we have money in our pocket 14,000, and you are in dire need of 15,667, and you called your friend for money that please help me. How much money you will demand from your friend? Will you demand the entire 15,667 from your friend to help you, or will you only demand the extra which you need? Will you want your friend to bear all the expenses, or you will only demand the additional you need? I think we should only demand what the extra we need, because when we have 14,000 in your pocket, first use the money in your pocket, and once it is consumed, if you need, then please seek help. So the entries will be revaluation surplus, debit 14,000. First use your own pocket. Total fall in the value of the machine is equal to 15,667. Any excess you can demand from your friend P&L. So P&L is like your friend, which will help us in the times of need, and we said, okay, please help us with the difference amount. 1,667 we charged to the P&L, we sought help. So subsequent revaluation will depend on what happened first time. If you already have reserve, first consume the reserve. Any excess you charge to P&L. If you don't have any reserve, then we have no choice. We have to charge it anyway to P&L. The second scenario was if first time revaluation was upwards. If first time revaluation was upwards, what we did? We charged to P&L, if you remember. first time revaluation we charge to P&L. And this is what we did. The machine had fallen to 40. And suppose after 2 years, the net book value of the machine is this. And we revalue the machine to an amount of 65,000. How much increase? 65,000 minus 26,667. Will you say that we are rich by 38,333, or will you remember your friend P&L who helped you when this machine value has fallen to 40 and they helped you with 28,000? You didn't have any money in your own pockets, so you sought help from P&L friend that please help. I don't have any money in my pocket, means I don't have any reserve. So please guide, please help. This is first time revaluation and we have fallen. So I need your support. So our friend helped us with 28,000 charge to P&L. Now in future we have recovered, we are better off now. We are in a position that the machine took a U-turn and the value of the machine has risen to 65,000. Will we cash the money or show in our balance sheet as revaluation surplus, or would you like to remember your friend and pay back? Or would you like to remember your friend and pay back to him or her? That please take back your 28,000. Any excess I can show as a reserve. That I am rich by the difference. We are not rich by entire 38,333 because we had already charged to P&L. And P&L is waiting to get reversed. That hopefully since you have recovered now, please pay back my money. And for any additional amount you can create a reserve. Please don't create a reserve for the entire amount. That will not be fair. So what will be the entry? What will be the entry? We'll not create entire amount as a balance. We'll first reverse any charge to P&L any excess you can create a reserve. Any excess you can create a reserve. Got the point? First reverse any charge to P&L. So what will be the entries? P&L account will be credited. Our friend will be repaid for the amount they supported, that was 28,000 initially, which was debited. So we'll first credit that amount. There is a total debit of 38,333, which has increased in the machine value. Machine has increased by 38,333. Any excess we can create a reserve, that is credit revaluation surplus. Hope you got it. So in today's session, I think I was supposed to discuss in slide by slide I'll be discussing it tomorrow. I'll be taking you through the slides tomorrow. But since I was in the flow and wanted to share the insight and the difference between the manner of presentation and how it impacts your accounting in future on the basis of the model used in accounting under IND AS 16 PP, that is cost model or revaluation model. And I again repeat that applying or moving on from cost model to revaluation models, there are two models in IND AS 16 PP, and you can use it separately. For one class of assets, you can use cost model. For another class, you can use revaluation model. Like if you have furnitures and fittings can be at cost model, and your land and buildings you can decide to move to revaluation model. This is possible. Separate class of assets, it is possible. But if you revalue one land and building, you have to revalue the entire class of land and buildings. If you revalue one furniture and fittings or plant and equipment, you need to revalue the entire class of plant and equipments. You cannot have both the models within one category. Different categories you can have different models. That's allowed. And when we apply revaluation model, it is not considered a change in accounting policy. It is considered applying an accounting policy for the first time. Applying an accounting policy for first time. What difference does it make to our life? When we consider it applying an accounting policy for the first time, we do not need to apply the effect retrospectively, and we can move on applying revaluation model hereafter. We don't have to bring any change with retrospective effect. Another thing is revaluation is not necessary to be done on each reporting date. Revaluation is done at fair value. Revaluation is done with sufficient regularity, and sufficient regularity has no definition. It can be 3 years, 4 years, depending on the management. Whenever they feel that the asset is materially different from its fair value or the value at which it is recorded in the books, then we get into a revaluation exercise, and the standard on impairment is automatically being applied because we do revaluation with sufficient regularity. When there are indications of impairment, definitely we'll do revaluation. And when we do this revaluation, if there is a first time fall, we take the difference to P&L. A first time increase, we take the difference to revaluation surplus, and subsequent fall, we first charge to surplus, any excess we charge to P&L. So the model in itself is capable of taking care of the impairment losses. The standard impairment of assets is applicable to it, but the model itself is capable of taking care of the fall in values whenever there is an impairment. When there is an increase, we are able to record an increase as well. When it is at cost model, when the asset is at your cost model and if you change the value to fair value, it gives an indication to the world that you have moved on to revaluation model. Otherwise, if there is any impairment under cost model, it can reverse. Like if I rate the impairment relating to it, impairment to cost model is applicable, and reversal is possible. Reversal of impairment is possible only to the extent of cost. What is the relevance of this line? Because if you try to go beyond the extent of cost, you are declaring to the world that you plan to change the model. You plan to change the model from cost model to revaluation model. That's an indication you plan to give. So is the reason the cost model assets can be impaired, and if they reverse, they can reverse only to the extent of cost. And what would have been the cost had it not been impaired? Only to that level it can come back. Because the moment we try to value it beyond cost, we are giving an indication or declaring that we are changing the model. And once we change the model from cost model to revaluation model, we cannot come back. Because we'll never be able to prove that cost model gives fairer presentation than revaluation model. It will not be possible for us to prove it. So first time revaluation results in either upward movements or either downward movements, and depending on it our accounting gets followed. So if I give a refresh of the depreciation methods or why we use a different method, we charge depreciation because we wish to recover this value either by use of the asset or either by sale of this asset. If it is by sale of this asset, then this standard is not applicable. Only when we plan to consume that asset into the business, IND AS 16 PP is applicable. The next comes, what is the manner of presentation? You want to directly reduce the depreciation from the historical cost. You want to present it at net book value. This is the manner of presentation. And if you want to create an allowance for depreciation, you track the depreciation. This is the manner of presentation. You create an accumulated depreciation account and balance. Now this manner of presentation determines your future accounting. It has a lot to do with your accounting in future, because the language, the terms, the fair valuation, how you do it is dependent on what you did earlier. Whatever was the manner of presentation determines your accounting in future. If there is a first time increase, you create a revaluation surplus. If there is a first time decrease, you charge to P&L. Subsequent to what happened first, if first time there was an increase and subsequently there is a further increase, your revaluation surplus gets increased with an additional amount. If first time there was a surplus, so it's not necessary that once it is increased in value, it will not further increase. It can increase further. So the revaluation surplus can build up again. But if it falls, you have a surplus to first consume, and any excess you can charge to P&L. If first time there is a fall, you have already charged it to P&L, and subsequent again there is a fall, please charge it to P&L again. Don't be emotional. So first time revaluation, there is a fall, charge to P&L. Subsequent revaluation, if there is an increase, first reverse the charge to P&L, and then you have every right to create a reserve. But don't create a reserve ahead of giving back to your friend P&L who supported you in your tough times. Okay, so please give back to P&L, then only create any excess reserve. Another important fact is that if you have a revaluation surplus which results in additional depreciation being charged to P&L because of increase in value, unrealized gain, because of revaluation surplus there is an excess depreciation being charged to P&L. So some of the accountants don't like this. They say that this is not fair. Our P&L is being hit every year and our retained earnings are also getting impacted. So there is a choice given to them that you can transfer excess depreciation from revaluation surplus to retained earnings each year to minimize this impact. Or if this is not a material amount and you can wait, since everyone knows that we are having a revaluation surplus, we are tracking it as well, we are charging depreciation on the revalued amounts, everyone knows this fact. So when you de-recognize or dispose of this asset, any revaluation surplus relating to it can be transferred directly to retained earnings, and this is one area which forms part of OCI. This is never reclassified to P&L, and in one lump sum amount you can transfer the entire balance of revaluation surplus to retained earnings, which will automatically set off the irregularity happening over the years. So this is a choice given under IND AS 16 PP. So this is all I plan to discuss for today. I'll be continuing with the presentation tomorrow in my IND AS 16 PP cost series. I'll be discussing the entire presentation with you, in which I'll be discussing with you some examples, depreciation methods I've already discussed with you, but I'll again take you through them. Another concept I plan to discuss with you is component accounting. How we plan to recognize cost model or revaluation model, and what is the cost consisting of, what we cannot include, what is dismantling, and how is dismantling resulting in creating a provision as well as increasing the value of an asset and charging depreciation also on this dismantling cost, which is added as part of the cost of asset. With an example we'll discuss it, how to deal with exchange of assets, and what if we are self-constructing an asset, can we capitalize the cost, or if we are simply maintaining it, what should be done, and how is major inspection on overhaul also treated as a replacement part. So we'll discuss with these replaced parts. The two models I discussed with you today was cost model and revolution model. I went in reverse manner, but it is fine as long as we understand PP, but that's how we understand it better. This is I'll be discussing with you tomorrow. So thanks for your valuable time and see you again tomorrow. I would request you to follow me on Unacademy. I'm teaching CA final, financial reporting, ACC Amit Kumar, and use the code ACC Amit to subscribe on Unacademy. And we'll be meeting you now on Wednesday and Friday. Thanks for your valuable time. See you again on Wednesday.